Hello everyone, welcome back to the next of our ACCA P2 lecture recaps. This is a recap of the full course lectures available on our website shown below, and also don't forget that you can get all of our mind maps as a PDF for free on that website. This was looking at our group fair values. So this time we're going to look at consideration. And then the next time we look at fair value of net assets. So remember that fair values is all set out in IFRS 3. Remember, the core of IFRS 3 is that basically we should measure all of our consideration at fair value and also our assets and liabilities at fair value. So looking at consideration, first of all, what is consideration? Well, remember, it's the cost of your investment, the amount that you've paid for the subsidiary. And as I've said, the key is that it must be at fair value. Fair value is the amount exchanged in an arm's length transaction between informed and willing parties. So when we're talking about consideration, it might be cash, it might be shares issued by the parent in exchange for shares in the subsidiary. It could be what's called deferred consideration, which is paid at a later date. So that might be in the form of cash, or it could be in the form of shares. Lastly, we could have contingent consideration. Contingent consideration is something that is paid in the future, but it depends on another event. For example, you might say, well, I'll set you a profit target, and if you meet that profit target over the next 3 years, we pay another amount of money in exchange for the business. So those are the different types of consideration that we need to look at. And remember, the key is that we need to get the fair value of each one. So fair value, first of all, of cash, well, that's very simple. It's simply the amount that's been paid. For the shares that are issued, the fair value is the market value of the shares. So the market value of the shares that are issued is the fair value. Deferred consideration. Deferred consideration, what we're going to do with that is that we're not going to pay it immediately. It's deferred until later, so it's paid later. So what we need to get is the present value of the future cash flow. Effectively, what we do is we discount the deferred consideration. We discount the deferred consideration, and the steps to do that is you discount it first of all. You discount it for the full time period. So if it's 3 years, you discount it for the 3 years, and you carry that as a liability. So you debit your goodwill working with your present value of the future cash flow, the discounted consideration, and you credit a liability on the statement of financial position. With that liability, what you do is every year until payment, you increase it. So you increase the liability every year by unwinding the discount. So we did an example of that, 10,000 in 3 years at 10%. So let's just run through that very quickly now. The first step then in our deferred consideration is to discount the amount. So we have 10,000 in 3 years at a cost of capital of 10%. So the discount rate for 3 years at 10% from the discount tables is 0.751. So the present value of the future cash flow is 10,000 times 0.751, 7,510. So that's our opening balance. So that will be our debit to the goodwill working for our consideration, and the credit will be to a liability. So our liability in 3 years, 7,510, present value of the future cash flow. So each year we need to unwind that discount. So we do that by multiplying the 7,510 by the 10%. That's charged to the income statement, debit the income statement, credit our liability to increase it. No cash paid, so our closing balance is 8261, the 7,510 plus the 751. That then is our opening balance for the next year. Again, our finance charge to be debited to the income statement and credited to the liability is 826, 10% of the opening balance. Add those together and we get 9087. So our opening balance in year 3 is 9087. Again, our finance charge is 10% of that. So that's debited to the income statement, credit to the liability to increase it, so that when we pay our cash, our deferred consideration payable in year 3, it wipes out the liability and we have a closing balance of 0. So the only difference there is a slight rounding difference. We then went on to look at contingent consideration. Remember, contingent consideration is always brought into the goodwill working in full. So if it's cash, we bring in a provision in the statement of financial position. So we debit the goodwill working with the full amount of the contingent consideration, and then we recognise a provision. If we don't subsequently have to pay that consideration, we then de-recognise the provision and take the gain to income. We don't change our goodwill working. When it's shares, well, the value of the shares will be the consideration, and that's at the acquisition date. So we did illustration 6 that covered all of that. Other aspects, when we're talking about acquisition fees, for example, legal and professional fees, remember IFRS 3 says that we write those off to income. If we have issue costs, those issue costs are written off to the share premium account. So if you have issue costs for equity, you write them off to the share premium account by debiting share premium and crediting cash. That brought us on to goodwill. When we were looking at IFRS 3, we saw that there were two ways to calculate your goodwill. There was using the proportion of net assets and the fair value of the non-controlling interest. So the proportionate goodwill is the old way, and it is simply this: cost of the investment less the parent share of net assets at acquisition equals the goodwill. The non-controlling interest then is the non-controlling interest share of the net assets at the year end. However, there's a problem with that conceptually. There's no goodwill attributed to the non-controlling interest. We do allocate all of the other assets to the non-controlling interest, but not goodwill. So it could be said that that's inconsistent. When it comes to gross goodwill, this does allocate some goodwill to the non-controlling interest. So what we need to do is we need to calculate goodwill normally, same as our proportionate method, and that will be the parent's share of goodwill. The non-controlling interest then will get a share of goodwill, and we calculate that as the fair value of the non-controlling interest's shares. So that's the share price at acquisition. So if we had a non-controlling interest of 20%, we would take the number of shares times 20% times the market value of those shares, and that would get the fair value of the non-controlling interest's shareholding. So we need that at acquisition, and we'll subtract from that the non-controlling interest's share of the fair value of net assets in working 2. So there's non-controlling interest share of the fair value of net assets from working 2, and that gives us the goodwill attributable to the non-controlling interest. We then add together the parent's share and the non-controlling interest share, and that gives us gross goodwill. So the workings to do this, the gross goodwill working then is this one. The top bit is just the same as proportionate goodwill, cost of the parent's investment less the parent's percentage of net assets at acquisition gives us the goodwill attributable to the parent. Then the bit that's attributable to the NCI, we take the fair value of the NCI at acquisition. Usually you'll just be given that in the question. If you have to calculate it, use the share price of the NCI at acquisition, less the NCI's percentage of net assets at acquisition, and that comes from your working 2. So we used the parent's percentage of net assets in the top. We're going to use the NCI's percentage of net assets in the bottom. That will give us our goodwill attributable to the non-controlling interest. Add those both together, the parent and the NCI, and that gets us our gross goodwill. To calculate our NCI then, we need to add in that goodwill attributable to the NCI. So their percentage of net assets at the year end plus the goodwill that's attributable to them. And we did an illustration of that in class. So that was our lecture 5 on group fair values.